Good afternoon to our dear participants for today's program. I welcome you to our today's webinar on the topic of what attracts venture capital. The objective of the session is to upskill the startups and innovators with the skills and knowledge about startup fundraising and venture capital awareness. The recording of the session will be uploaded on our YouTube channel, that is Goa State Innovation Council. We request you to kindly subscribe for the channel so that you can be updated with the recordings of this program, plus additionally to our other programs. On behalf of the Goa State Innovation Council, I would like to welcome our speaker for today's session, Mr. Vikrant Potnes. Vikrant, having worked with the organizations such as Springboard Ventures, JP Morgan, and Mumbai Angels, has expertise in venture capital and investment banking. He has worked on transactions upward of rupees 200 crores. He has closely worked in equity fund raising execution across sectors such as consumer, pharma, technology, and healthcare. Currently heads SPTBI, a DST-funded incubator, and is a visiting faculty of entrepreneurship and venture capital in leading Indian B schools and startup accelerators. We welcome you, Vikrant, for today's session, and over to you. Thank you.
Thank you so much, Sudeep. Thanks a lot. And it's an absolute pleasure actually to conduct this session for all of you. So happy to see so many participants. What I'm going to do is I'm going to just start sharing my screen, and we are going to start the presentation shortly. Just give me a minute. I will just share my screen, prepare myself to speak to you guys, and we will begin. So in 20 seconds, I will be online again. Great. So I hope my screen is visible to all of you. So today's session, like mentioned by Sudeep, is all about capital raising. It's all about fundraising. And for a startup today, raising capital has become very, very important, very, very critical. In today's session, what we are going to understand is what are the steps which are there in raising capital. Let's first start by understanding steps in raising capital. Next, we are going to look at a matrix. I'm going to give you a matrix called fundability matrix that can tell you precisely what do investors look at, what do venture capital investors actually look at before investing in your company, before investing in your business. If you were to ask that, hey, tell me things that investors look at before investing, what are those things that I need to keep in mind, then I'm going to leave you with a matrix through which you will be precisely able to tell in terms of what exactly do VCs look at. Finally, which investors should I reach out to and how to approach investors for raising capital. These are the two important questions which we are going to understand. So what is it? What are the steps? What do investors look for? Which investors do I reach out to? And while I'm reaching out to these investors, what is the approach that I need to have before reaching out to these investors? So with that as the context, let us begin. Let us start our session with the first thing, which is steps in capital raising. So friends, capital raising for startups is a long journey. It is not as easy as creating a business plan and pitching to the investors. There are a lot of different technical steps that are a part of capital raising process. And these steps are very, very intense, and each step requires a specific knowledge that you need to build on your side. So what are these steps? Obviously, all of you know that first it all starts with preparation of business plan and financial model, which means you create a business plan and you create your financial projections. Then you reach out to the investors. You find the right set of investors. How are you going to do that? I'm going to tell you, I'm going to give you precise steps on that. That finding the right set of investors, and then you reach out to these investors. Once you reach out to these investors, you pitch your business plan, right? You talk to them about your business. What are the key factors in your business, the team, the product, the market, etc. That is what you talk to or tell the investors. Next is, which is a very crucial step, guys, where you discuss valuation. Now, what exactly is valuation? Valuation is basically, the 100% worth of your business. So what is the 100% worth of your company? Or what valuation in capital raising means is, if you are looking to raise 1 crore of funding, how much stake are you supposed to give to the investor? Should you be giving 10% stake? Should you be giving 5% stake? Should you be giving 20% stake? The correlation between the amount of money that you want to raise for your startup and the percentage stake that you are going to give to the investor, this correlation precisely defines the valuation. There are various tools, techniques, and methods that we use to value companies which are at an early stage. And there are various structures such as a compulsorily convertible debenture structure, a convertible note structure, etc., which we use to essentially do a deal. Obviously, in today's session, we will not be able to cover that. I'm going to cover the more basic points today, and in future, with Sudeep's help, we can possibly go ahead and talk about each of these topics in detail. Once the investor agrees to invest in you and defines the valuation, then he issues a term sheet to you. The term sheet has all the terms and conditions related to the fundraise. Valuation is just one term. There are a lot of other terms such as anti-dilution, ROFR, buyback, exit right, etc., that become a part of your transaction, that become a part of the deal. Now, term sheet is like a letter of intent, which means the investor is telling you that, hey, you know what, I'm looking to invest in you, I'm wanting to invest in you, and these are the terms and conditions. Then a due diligence process happens where your accounts, where your legal aspects are checked by a third party. And finally, the term sheet, which is a letter of intent, gets converted into a legally binding agreement called as shareholders agreement. So shareholders agreement is like marriage. Term sheet is like engagement. So during the term sheet stage, the investor says, yeah. Now we one day we will get married. And now during the shareholders agreement, it is like actually getting married to the investor, right? So the deal happens. Once the shareholders agreement is signed, that is when the money goes from the investor's bank account to the company's bank account. And then there are certain post-funding compliances such as issuance of shares to the investors. So what I'm trying to give you a perspective of before we get into what investors really look at, one thing which I want to tell you is these are the 8 steps that become a part of the capital raising process. These are the 8 steps that are a part of any capital raise. Whether you are raising money from an incubator, whether you are raising money from an angel investor, whether you are raising money from a venture capital investor, whatever might be the quantum of capital, whatever might be the source of capital, when it comes to raising equity money for startups, typically these are the 7-8 steps which are actually followed. Very important steps in this is obviously finding the investor, valuation, term sheet, the shareholders agreement, and finally the money in the bank. So each of these steps require a different skill set. Each of these steps requires certain understanding of law, finance, business, etc. And a combination of all of that is the capital raising process that we know about or that we aspire to do as entrepreneurs. Uh, Now, once we've understood the steps involved in capital raising, I'm going to take you through what do investors really look at or focus on before investing. And, I want to actually understand it more from you, right? Let's understand, let's see if you guys were investors or if you guys were looking at, say, startups, right? And investing in startups. What is it? What is it that you would look at before investing in a startup? You can type in your responses on the chat window. And what we are going to do is we are going to actually create our own theses. We are going to actually create our own understanding. We are going to actually create our own premise of what investors look at, because this is a very logical process, guys, and I'm going to take you through the logical process. And Sneha is mentioning that you would look at business sustainability before investing in any startup. Business sustainability, very important point. Anyone else who wants to think of it? It's very logical, right? When you look at investing in startups, when you look at investing in any asset, for example, what would you look at? And very good, I would say, response is coming from Prantik, and that is monetization capability. What is monetization capabilities? That how will you actually make money from your business? How can you monetize the business? Future scope of the company is what Mr. Nandan is saying. Yes, definitely. How does the future of this company and the scope of this company look like? Absolutely right. There are so many people, like 85 plus people on the platform today. I need more responses from you guys. Think of it. We're here to essentially understand how to look at investing in startups, and what as startups you need to keep in mind to raise money. So profit making capacity of the company, the team, very critical. Excellent management of the company. And then sir is saying management of the company. How much return will I get? The product. I feel I should just note down all your points, and this becomes a thesis document in itself. Really great. These are what all the things that any investor will look like. Now, let me ask one question to all of you. All of you are absolutely right. Let me now ask one question to you. What is the topmost thing? Okay. Or what is that one thing that you will keep in mind or you will look at before investing in a startup? That one thing which is going to be non-negotiable for you. What is that one thing basis which you will actually take a call to invest in a startup? Rest all things great, but that one thing, most important thing for you, what would be the most important thing for you? uh, Profitability. A lot of people are saying, profitability, market size. Guys, most important thing, money. Okay. Return on investment, security, returns. Okay, guys. So let me tell you, product. Okay, again. So let me tell you, and let me tell you the first principle of equity funding and venture capital, especially early stage. The first thing that the investor looks at is not the market size, is not the returns, is not how great your product is. The first thing, I'm saying these are important aspects, but the first thing that the VC fund looks at or any angel investor looks at is not any of these points. The first thing that they look at is the most important point of any early stage business, guys, is the team. Yes, Suvarna ma'am, you mentioned it. You're right, it's the team. Why? Why is it that the team is very important? Because what is a startup, guys? 3 or 4 founders coming together working on a business idea at an initial stage. At a later stage, maybe when you are talking about possibly a listed company, a large company, that is the time when you will look at profitability, etc., in very greater detail. But in this stage, at such an early stage of your journey, what is a startup? A startup is nothing but a set of co-founders. Do they have the execution ability to transform an idea into a product and then the product into P&L? What do I mean by product into P&L? Can you monetize that product? Does the core team have that ability? Because business models are going to undergo several iterations. Product is going to change, your customer segments are going to continuously change, and we have large companies as examples of this. Snapdeal started off as a coupon selling website, a discount coupon selling website, pivoted towards an full-fledged e-commerce player. The business model underwent a complete change, but still investors kept investing. Why? Because the belief was for the team. The belief was behind the team, the co-founders that actually, are running the business. So, you know what? A lot of times when we attend pitches, when we look at investments, there are these pitches, and people jump into, this is my product. This is how it is better than competition. I have built so many features. This is a unique idea which is not there in the world. They keep talking about their product. So we tell them, pause. Can you just first tell us what is your background? Because a great founder can make millions of dollars from a very, very simple product, and a not so good founder can actually not make any money from a highly innovative product, right? So guys, always remember, when you are pitching to the investor, you have to pitch the company holistically and not just your product. This is not a product pitch. Understand what is the difference between the innovator and the entrepreneur. Innovator makes amazing quality products, new products which are never seen, great features, etc. An entrepreneur is also an innovator, but is one step ahead, which means what? He has the ability to take that product and to make money out of it, right? There are so many people today building flying cars. I'm just giving you an example. You know which guy will get the funding? The one who has the ability to actually make money from the flying car business. Rest, there will be so many innovations happening. But who will get venture capital funding? The person who will actually, who can actually make money out of it is the one who will get venture capital money. So always remember, team is the most important point, guys, while you are looking at raising capital. It is all about co-founding team. Now, what do they look at within the co-founding team? Relevant experience, uh, co-founders coming from diverse backgrounds, relevant experience, diverse background, and some bit of business knowledge, right? Today, let me give you some statistic. Today in India, the average age of a funded entrepreneur is somewhere between 35 to 40, which means a good 10 years of experience, at least 10 years of work experience has happened, and then the entrepreneur has been able to raise money. Yes, there are cases where a college dropout or someone in his very early 20s has raised billions of dollars. But if you see the average age, typically it is between 35 to 40. Also, if there is a choice between three co-founders, all coming from technology background, all engineers, all very good at creating a product, versus three co-founders coming, one from great technology background, savvy to build products, second from the business development sides of things, understanding how this product can be sold, and third from operations and finance side, who can actually raise rounds of funding consistently. Which company would you choose? Obviously you would choose the second company. Why? Because you will develop a great product with these three co-founders who are all techies, all experts in product development. They will be able to develop the product, but who's going to sell the product? Who will take the product to the market? Who will find customers for this product, right? So diverse background, relevant experience is what people look at in a team. So if you are a founder, if you are a startup, if you are a entrepreneur wanting to raise money, always remember, you have to build a solid team. You have to showcase a strong team coming in from diverse backgrounds. And that is the first step towards capital raising, right? Very, very critical. Get co-founders, get people from like-minded backgrounds, get experts, get these diverse set of guys as a part of your team, and actually, take your startup to the next level. So that's the first point. The image that you see on your screen is what is a proprietary developed tool by my company, Indian Academy of Venture Capital, which gives you points that you need to actually look at before raising capital, or what is it that venture capital investors would look at. This has evolved after 10 years of experience of capital raising for businesses, right? So that has been the experience for creating this tool. The second point, which is important, guys, and please make a note of this point, very, very critical, scalable business model. Now, what do I mean by scalable business model? Venture capital investors, angels, all of them invest only in businesses that have a scalable business model. Now, what is scalable business model? What is an example of scalable business model? What do we mean by scalable business model? Let me give you an example. And from a venture capital perspective, I'm going to give you an example or a definition of scalability. And the definition of scalability is, try and understand this. So for every 5 rupee of incremental revenue, if you have to raise 2 rupees of capital every time, then your business is not scalable. Let me give you an example. Okay. Let's consider a mall business, a shopping mall business, a shopping mall business. Now, what does it take to actually, create a shopping mall? What is it that you will have to do to create a shopping mall? One is you will have to lease land. You will have to physically construct the mall. You will then have to get the tenants. Now, all of this, say, requires 10 crores of funding, right? So to buy the land or lease the land, to construct the mall, to actually get the tenants in place, all of this requires, say, 10 crores of funding. Once the mall is operational, the mall owner is going to make, say, 50 crore rupees of revenue from that mall through lease, through sales, etc. Right? So you constructed a mall that required 10 crores, and now that mall is giving you a revenue of 50 crore rupees. Now, as a mall owner, if I have to add additional 50 crore rupees to my business, if I, as a mall owner, have to kind of take my business from current 50 crores to 100 crores, what is it that I will have to do? What is it that I will have to do? Any ideas, any thoughts? If I'm a mall company and I want to actually now go and essentially, double my revenue from the current 50 crores to 100 crores, what will I have to do? What is it that I will have to do? Any ideas, any thoughts, guys? Anything that comes to your mind? Logical answer, think of it. Very, very logical. I'm going to just give you 10 seconds to invest, right? What you will have to do is, again, put 10 crore rupees in actually creating another mall. And that is what you will have to do. Iska kya matlab hua? What does it mean? That every time a mall owner has to increase his revenue by 50 crores, the first thing that he will have to do is to put in 10 crores in the business. Only and only then he will be able to grow his business from 50 crores to 100 crores. Now, according to venture capital investor, guys, this is a non-scalable business. Now, what is a scalable version of this business? One website that could service the entire nation without having the need to physically construct a mall. Why did e-commerce receive so much investment? It was because of the scalable nature of the same business model. The same thing is done by the malls. E-commerce guys are not doing anything different. Why did e-commerce receive billions and billions of dollars of venture capital investment? Because of the scalability nature of the business. Once you create a website, once you have the logistics in place, Now you don't have to go on creating new malls every time. All that you have to do is launch it in new geographies. So an Amazon today is not just in the US, but is across the globe today without any physical investment, without any kind of an investment in that particular infrastructure, right? So that is precisely what we mean by scalable business. For every for every 5 rupee of revenue, are you requiring 2 rupees of capital? If for every 5 rupee of revenue you require 2 rupees of capital investment, then your business is not scalable. And I have given you a definition of that, right? Um, One very good example I want to give you guys is, you would have heard of this brand called Cycle Agarbatti. Uh, do you know Cycle Agarbatti? It's an Agarbatti brand. It is a funded company. It is funded by private equity investors. They have raised, crores of rupees, hundreds of crores of rupees. Imagine a simple product like Agarbatti today is actually funded. How did they make it scalable? Earlier, they were actually manufacturing the Agarbatti. Then they realized, you know what, there are so many manufacturers. Why do I need to depend on my manufacturing? I am going to create the recipe, the fragrance, that recipe I'm going to create, and I'm going to sell in market. But I don't need to physically construct the factory. I can outsource it completely. I can package it completely outside. All that I'm owning is the brand. All that I'm owning is the distribution. And therefore, a business like an Agarbatti business can also be made scalable or asset light, right? So this is what we call as scalable business, guys, which is the second most important thing when it comes to capital raising. The third thing which is important, guys, and this is a very important topic which I'm going to delve deep into and touch upon, is value proposition. And you would have heard of this. If you are a startup founder, you would have heard of this. What is value proposition? Value proposition is nothing but the pain point that your business is solving. What is the end pain point that you are actually solving for the customers? Now, there are two types of businesses. One is a vitamin business, another is a painkiller business. And let me explain you this in terms of value proposition. Now, what is a vitamin business? All of us know that vitamin D is good for us. All of us know that it is important for us, for our bones, etc., etc. But how many of us today actually took a tablet of vitamin D? Not many. I did not. Why? Because even without consuming that, I can still stand in front of you today and deliver a session. But what if in the morning before this session, I would have slipped in the bathroom and broken my bone? Then the thing that I need, and I will call up someone and I will say that, hey, you know what? Get me this tablet of painkiller. Pay whatever he is asking for, give whatever money, bring it to me, and bring it to me right now. Right now, I need it. Businesses are also of these two kinds. There is a vitamin business and there is a painkiller business. Now, in vitamin business, it's a good to have business. Customers will tell you that, hey, yeah, अच्छा है, पर दो दिन बाद मिलते हैं. We will come back to you. Let us think. Whereas a painkiller business, those guys would keep calling you up and say that, boss, why have you not yet delivered your service or your product? What kind of business are you? Are you a vitamin business or are you a painkiller business? Always remember, a painkiller business is one that gets venture capital funding. VCs typically look at painkiller businesses, and painkiller businesses are the ones. Why? Because it is very obvious, right? It has higher margins, it has a higher amount of monetization capability, higher amount of, I would say, pull when it comes to customers. One thing which I want to tell you is, always remember, whether you are talking about painkiller or vitamin, always keep in mind the customer segment. you have to keep in mind the customer segment. Because for one customer segment, a business can be painkiller, but the same business for another customer segment can be a vitamin business. So you have to keep in mind which customer segment are you talking about. So write down your value proposition here. Write it down that what is your value proposition? Are you a painkiller business? Are you a vitamin business? What is the end pain point that you are solving? Lot of times in technology institutions and engineering colleges, I see startup founders making technology products. They are in love with their technology. They have built AI into it. They have built ML. They have created a product, very, very fancy, extremely, complex product. But they have not asked a single question, this single question to them, that who is going to buy this product? And whatever the product is solving as a problem, is that problem big enough? Is someone going to pay money to me, right? And that is something which is very, very important, guys. While you are developing the product, always remember to ask this question, that is this solving someone's pain point, and will someone pay for this? Very important. If you're creating a great product, however it is not solving a pain point, and if it is not giving money to you, customers are not willing to buy that, then you cannot create a business out of it. And because you cannot create a business out of it, you will not be able to raise money for it, because VCs would not then come in. No one would want to come in. So that's the third block on the fund enable matrix, which is value proposition. So three things what we have seen until now: team, scalable business model, value proposition. I'm going to take a quick 10-second break for you to put down any questions that you have related to the topic, related to the points that we have discussed so far. Just go through your notes, just read these points, look at your business. If you have any questions related to this point, please put it on the chat window. I'm just going to wait for 10 seconds. If there are questions, I'll answer those and then we will move. If not, then I will continue. So see you in 10 seconds, guys. Great. So there are no questions. I'm going to move forward, guys. So the next point, which is extremely critical from an investor's perspective, guys, is proof of concept. And this is one point, again, which I want to highlight to all of you guys. When does a venture capital investor come in? When your idea is actually proven, when your idea has found first set of paying customers. That is the point, guys, when the venture capital investor actually comes in and invests in your business. A lot of people come to us and say that, you know what, I have a great idea, give me money. You might have a great idea, guys. You might have a very, very good idea, innovative idea, but you will not be able to raise money from a venture capital investor only on the basis of your idea. Because what is a business? A business is executing an idea and making money out of it. So idea is one point, which is important. So investor likes your idea. Now what he wants to see is, are you the right set of guys who can execute this idea? And that is what we call as proof of concept. Do you have paying customers? Is your idea, do you have people who are willing to buy your product or service in the market. That is the point, guys, when actually venture capital investors come in and invest. It means what? This means that from the idea, prototype to proof of concept stage. So from idea, you will convert it into a prototype or a product. And then from product, you will go to the proof of concept state from the customer validation point of view. In this phase, you will need money. Where will this money come from? The first source of this money is you yourself. Always remember basic principles of entrepreneurship. If you go by the definition, an entrepreneur is a person who takes risk, who brings in his own capital to actually start a venture, right? So, actually speaking, guys, the first set of investors for you are going to be your friends, your family, and you yourself. Initial amount of capital has to be brought in from these sources. Fortunately, today in India, we have a base of incubation centers, and incubators are also playing a very, very critical role in actually supporting startups which are at a prototype stage to help them to reach to the proof of concept stage by giving certain seed funding, grants, etc., depending on the quality, right? They are very, very careful and very, very stringent about the quality, guys. And very strict when it comes to their own criteria. But this is the kind of funding that you will get from your idea stage to your proof of concept stage. And now at the proof of concept stage, you will actually get to raise venture capital funding. So if you are imagining, if you are sitting and imagining that, hey, I have great idea and I'm going to get an investor, then the probability of that, my dear friends, is very, very low. Because only on the basis of the idea, people do not invest. It is all about execution, right? Like I said, it is all about creating a venture out of your idea. So this point is a very critical point, and a lot of misconceptions are there around this point. Please write down your proof of concept. At how much, how many customers do you have? What is the, what are the kind of customers? What is the stage at which you are? All of these points will be very, very critical. So on the canvas, on the fund enable matrix, you can see the team, the scalable business model, value proposition, proof of concept. These are the 4 primary blocks or 4 key things that any venture capital investor, that any investor is going to look at when it comes to your business. Now let's move on to the next set of pillars which VCs will look at. And the next point is monetization model, which you guys have already highlighted. What is monetization model? How is your business going to make money? It's as simple as this. How will your business make money? How will your business actually make? Will it sell subscriptions? Will it make commissions on sale? What is your revenue model? And that is what is studied in monetization model. How much are your margins? So on every product sale that you do, what is your margin structure like? Are you making money? So these are the kind of things which are actually looked at very, very intently in this 5th point, which is the monetization model. Simple way, simple thing to look at is how will your business make money. The next point is the market size. And market size point talks about how large is the market. Again, a very important point, and one of you guys mentioned this in the chat window as well. What is it that market size is? What is the base? How large is the market that you are currently operating in? Why is this important? If the market of your product is small, you will become a small company. If the market of your product is large, you will be able to become a massive company. All the large ticket investments that have come into India, you will see the base market for these companies is very, very large. Example, consider, grocery segment, right? Such a large market, and you have billions of dollars flowing into companies that are selling groceries. There is a e-commerce we saw. Retail market is so large, so much capital. Logistics is so large. Our travel market is so large, huge amount of investments going in. So always remember, whatever you are doing, if the base market is large, investments would come into your company. If the base market is not that large, if the base market is small, then investments, it's difficult, because market size is something which is looked at very, very closely while looking at raising a round of funding. The seventh point is exit strategy. And this is where your returns part is coming. Most of you mentioned that what is it that the investor will look at before investing? Returns. Yes. Exit means how will I actually make returns? Whether I will make returns by selling this investment to some other company, whether I will do an IPO, an initial public offering, how will I make money from this investment, right? Typically the route that is chosen by these companies or these investors who invest in companies are something like an acquisition. What we saw in case of Flipkart got acquired by Walmart. So all the investors of Flipkart exited, made money by selling their stake to Walmart. We've umpteen number of such examples. There is a company called Just Dial. Now, how did Just Dial investors made money? They made money when Just Dial actually listed on the stock market. So when Just Dial stock got listed, you and I actually bought the shares of Just Dial, and this shares came from the existing investors who sold it to us. So these are the ways in which exit is done. Potential for exit and how much is what is the way in which exit can be done is something which is actually looked at in monetization, in exit strategy. Finally, guys, the last point on the canvas, and then we complete our what does it take to raise money part. So what is the last point on the canvas is entry barrier. How will you ensure that someone does not easily replicate your business? This is a very important point that investors look for. What are the kind of moats that you are building? What are the kind of barriers that you are building? What is it that is so special about your business that will prevent someone from easily copying it? Today, I have a great idea. I launched that idea in the market. Tomorrow, someone with already sitting with 5 crore rupees, if he sees this idea or if he copies this idea, what will happen to me? My idea will go down the drain. That other guy will kill me because he has more money. So what is it that you have about your business that will actually ensure that essentially, your idea is not copied or your business is not actually easily replicated? That is something which is essentially very important to showcase. Uh, a question that I have for all of you is, all of us know about Flipkart. All of us know about e-commerce, right? Now, how much time does it take to actually create a website like Flipkart today? How much time is it taking in today's term to create a website, to create an e-commerce website? So not too much time, right? If today you start and start making a website, there are a lot of platforms. There are a lot of platforms that can actually ensure that your website is ready in the next 2 hours. Do you think there are any entry barriers for Flipkart today? Do you think there are any barriers that are there for Flipkart? Yes, there is a barrier. The barrier is that the company has raised so much amount of money. The company has raised so much amount of capital that today it is very difficult for us to compete with Flipkart. So what these guys did was that they realized that e-commerce as a website, etc., is very easy to create. What should we do? How can we ensure that no one can then manage or no one can dare to compete with us, raise so much amount of capital that an entry barrier is created? So that is what essentially is entry barrier created by companies. Some companies create entry barrier in terms of technology. Some companies create entry barrier in terms of in terms of the capital. Some of them create in terms of a business model, in terms of customers. What is it that you are thinking? What is it that you are doing when it comes to actually creating entry barrier for your business? So now, guys, the canvas, the points are ready. These are not only the points, but these are the most important points. If you only look at these points, and if you only ask me this question that, what is it that venture capital investors look at before investing? What is it that venture capital investors look at before putting money in any business? Then these are the 8 points that they will definitely look at. And these are going to be the most important points that they will look at before raising a round of funding. What you can do is on the canvas, you can write down what your current status is. So, for example, team, you have a CEO, CTO, maybe CMO is a gap. Put it out that, in my team, possibly CMO is a gap. Once I have that, from the team perspective, I am ready to raise capital. Value proposition, put it down. What is the value proposition that you have? Refine it, put it. Scalable business model, put it down. How is your business model scalable? Write it down there. Proof of concept, write it down. How much customers, or what is the validation level that you have at this point in time? All of this you can put in, and then you will be very, very clear from a point of view of understanding your essentially business model, and understanding what it takes to raise a round of funding. So, with this, we have completed the second part of our today's session. The first part was what are the steps involved in capital raising. The second part is what is it that investors really look at before raising or before investing in your business. The third part is how do I actually get investors, and the fourth part is how do I reach out to them. So what we are going to do now is, guys, I'm going to take a quick 2-minute break for you to actually, think of the first 2 points that we've discussed. Can completely imbibe those. It is 3:50. Exactly at 3:55, we will circle back. We will come back, and then we will look at the most important part of the story, or the question which a lot of people have is, where are these investors and how do I reach out to them? I'm going to give you precisely action points and steps to reach out to investors and to find the relevant investors. But that we will do it after a quick 5-minute break. So thank you so much. Please do stay on the Zoom link, and we will meet you in the next 5 minutes. Thank you. Welcome back, guys. And now, after the quick break, what we are going to do is we are going to look at the next two parts, important parts of our, session, which is how do you actually go about reaching out to investors. So let's straight away deep dive into this question of how do we reach out to investors. Uh, but before we actually look at how do we reach out to investors, let's look at whom do we reach out to. So before understanding how, it is very important to understand whom do we reach out to and what is precisely the way to reach out to investors. So let me tell you the wrong way first to reach out to investors. And the wrong way to reach out to investors is what most entrepreneurs follow, this path. And that path is called as the spray and pray path, which means what? You actually take hold of a list, you get hold of a list of investors, around 100, 150 investors. You get a list of these investors. And then what you do is you start emailing your business plans. You start emailing your business plans to all of them and say that I am looking to raise money, I'm looking to raise money, I'm looking to raise money. Or you go on LinkedIn and you start writing or sending emails to all those people who have mentioned investor on their actually title. Now guys, always remember, this is what we call as the false start. This is not how you actually raise a round of funding. The way you raise a round of funding is by actually targeting investors basis a certain criteria. If you target a few investors basis a certain criteria, the probability of funding goes up significantly. Now, what is one criteria? One criteria that we usually follow is sector and ticket size, which means what? If you are an agriculture based startup or if you are an IoT based company, now, and you are looking to raise 1 crore rupees, right? So if you are an agri-tech company looking to raise 1 crore company, which are the investors in the market currently who are looking to invest in agri-tech opportunities and whose ticket size, which means the amount that they are going to invest, is somewhere between 50 lakhs to 2 crores. Which are these guys? Can we find those guys out? Can we actually get a list of only those guys? If we are able to get a list of those guys, then we will be successful in capital raising. How do you go about doing that? So just to give you an example, if you are a healthcare company, if you are a healthcare startup, these are the set of investors that are investing in healthcare companies in India today. You can see on the screen, these are all the people that are actually investing in healthcare. And what we've done is we've segregated it as per the ticket size, which means the first column is the guys who are investing 0 to $1.5 million. The second column is 1.5 to 5, and so on. Now imagine if you are a healthcare company looking to raise 1 crore rupee, but you reach out to an investor who's actually looking to invest more than $10 million in a company. You will not get a reply. Or look at if you are a food tech company and you reach out to one of the investors in this particular list, again, you will not be able to actually, reach out, or you will not be actually able to get a response. So guys, what I'm trying to say is this intel, you will need to have it. Now, how do you have it? Keep a track of your sector. There are databases like Crunchbase. There are portals like Your Story, Inc. 42, VCC Edge, etc., where you get information about your particular sector and the startups which are getting funded by particular investors in your sector. Keep a track of it on a day-to-day basis. It's like this. If you are a stock market investor, every day you will read Economic Times, or every day you will watch CNBC. Similarly, you are a startup founder looking to raise money. These are the kind of databases that you have to look for every day. You have to see that, oh, in health tech, which is the guy who has invested? Oh, this is the company that got invested. How much did they raise? Oh, they raised 2.5 crores. And this data, guys, is readily available. Go to Crunchbase, go to VCCH, VC Circle, Inc 42, Your Story. You will get these details. You just have to keep a track of your sector on an ongoing basis. By doing that, you will not land up in a problem, the problem of knocking the wrong door. Most of the startups today are not able to raise money because of this point that we are seeing, the problem of knocking the wrong door. What they do is they reach out to guys who are not interested to look at their sector. They reach out to guys who are not interested to actually look at the ticket size that they are investing in, the stage that they are investing in, and therefore the startup does not get any response. I'm going to share a case study with you how this is possible, how we were able to do this. So consider this company. I'm giving you an example of a very, very interesting company called Under the Mango Tree. Now, what Under the Mango Tree does is, Under the Mango Tree actually, is a company that sells honey. It is a company that sells honey, but the way they do it is very different. What they do is, the company is focused on increasing the income of farmers. How do they do that? They go to farmers, small farmers, and they install or they set up this box called bee box. So if you are a lychee farmer in Bihar, and if Under the Mango Tree sets up a box on your farm, what will happen is the honeybees in the box will foster pollination, which means the bees will sit from one flower to another, another to another, etc. Because of that, yield will increase, which means if you were supposed to produce 100 kgs of lychee, you will now produce 120 kgs of lychee because there are bees on the field. And that will lead to increased income. Also, the byproduct of this is going to be honey. So Under the Mango Tree now buys this honey from the farmer and packages it and sells it as premium honey in the export market. Why premium? Because this is like single malt. Just the way we have single malt whiskey, this is single malt honey. How? The bottle will have lychee honey from that lychee farm. It will be a single flower honey, right? Single flora honey, which is sold in the international markets for a premium. Now, this is a company which was looking to raise money. There were two things that were peculiar about this company. One, it was a social impact company, which means it was actually helping farmers in increasing their income. And second, it was an agri and a food focused company. So what we saw was, we looked at actually investors in the Indian ecosystem, which are looking at social impact companies and which are looking at maybe agri companies. So these were the set of investors that came up. That there is an investor called Capital for Development, which is actually investing in companies specifically that create social impact, and they are looking at currently agri related opportunities. How did we get to know that? We went to their website, we saw what are their investments in the past, we saw how much money have they invested in the past, and with that we approached these set of investors. Now, when we approached these set of investors, we were able to actually close the round with one investor, which is Acumen, and this company raised 3 crore rupees from this investor called Acumen. All of this by only reaching out to 11 investors. Imagine, I have met startup founders who have a list of 200 investors and are shooting emails randomly to them. Wrong, not the way to do that. The way to do that is fine tune, like the way Under the Mango Tree has done. Just 10 to 11 investors, bases a criteria, and then you will be able to close a deal very easily. And this is what essentially is, the way you find investors. right? Using a particular criteria. Now, the question that I have, the next question that I have for you is that how do we approach investors? How do we kind of talk to them? Random emails, as I said, do not work. If you send random emails to investors, it does not work. The way it works is through introductions to the right decision makers. You have to introduce, you have to get introduced to the investor through someone in between. And this is what is very important. Today, incubation centers again are playing a very important role here, because they are actually a place where a lot of startups are there, and therefore investors look at startups at incubation centers. So typically an incubator writes an introductory email to the investor, or the other way to look at it is to find an insider with experience, with fundraising capability, preferably another founder. Get hold of a mentor, guys. Get hold of a person who is an insider, who knows how to do it, who has been there, who has done that, who has been a founder, and who can guide you and handhold you as a part of capital raising process. If you want, give him some equity, some sweat equity, something as a part of your company, but become actually I would say, I would request you to get hold of a mentor who can guide you, uh, and then who can introduce you to investors, who can open doors for you, who can provide you that foot in the door, and that's how you will be able to raise money, right? These are typically the ways in which you do that. The first round of funding that I raised for my company was from my ex-bosses. When I used to work for a company, I went back to all my previous companies and I said, I'm looking to raise money, please invest. The next set of investors I got through them, they then use their network to get me more investors. And that is typically how it happens. Your own personal network is what you have to bring to the table. Incubators, personal network, a mentor, all of that you have to bring to the table to actually go and raise a round of funding. And that is precisely what founders do while they actually look at capital raising. So, guys, today what I've done is I have given you insight into what needs to be done for actually capital raising. Also, my very personal opinion. But a lot of times you will see umpteen number of events these days that say that, hey, pay money, become a part of this event, and you will get to meet an investor. Be very careful with such events these days. Only go for reputed because most of the times you will find not real investors coming there, and you would end up spending your hard-earned money on just attending an event which is meant for making money in itself. Instead, focus on the real network. Go through reputed people, go through incubators, go through reputed mentors that are willing to help you, and that's how you can raise a round of funding. So that is what I would tell you. One last thing that I want to focus on, guys, and after that I want to leave the floor open for Q&A, live Q&A, is whenever you are pitching to the investor, there is a lot of material available already, and lot of talks that happen on how to go about pitching. So I'm not going to take you through that. The only point that I want to tell you is, whenever you pitch to an investor, don't talk only about a product. What people do is they stand in front of the investor and keep talking about their product. I have built this product. This product has so many features. This product is better than the competitor. This product comes at a price which is 10 times cheaper than the competitor. No, guys. Take them through your business. And what does your business contain? What is it comprises of? Tell them what the pain point that you are addressing. Tell them what is the profile of the customer. Tell them what is the team that you are all about. Tell them the financials, the positive unit economics. Talk to them about the product. All of this makes a business, not just product. Likewise, always understand the difference that I told you between the innovator and the entrepreneur. An entrepreneur is actually a superset which also consists of innovator, but he builds a solid team, he sells the product, he can build a positive unit economics, and so on and so forth, right? So always remember, all of that has to be highlighted and not just the product. Be very mindful about that one particular thing. So, uh, another point that I want to tell you very quickly is, don't pitch a funding dependent business plan, uh, which means that don't go to the investor when you are desperately looking for money, or when your business is about to die. That is not the time when you will get money. Go to them when you are expanding, when there are bottlenecks, which means what? I am actually in one city, I'm doing a business in one city, my business is happening very well in one city, and I feel I can be in 10 more cities. But for that, I need capital. That is the time when you have to go to the investor, not when I don't have salaries to pay now. Lot of times people come to us and say that, what, why do I need to raise money? Oh, what, in 3 months, if I'm not able to raise money, I won't be able to afford salaries, I will have to shut my business. That is not the time when you can raise money or when someone will invest. You can tell investor that, what, I will not die tomorrow. My business will continue. We are making good money. We are stable. Your money is only going to help me accelerate my business at a much faster pace. That is the time, guys, when you will get money from the investors. And that is what you should always remember, guys. That's it. Actually, from my side, a quick background about myself. While Sudeep mentioned, many of you can connect with me on LinkedIn with the Goa State Innovation. If you want to get in touch with me, I run a company called Fund Enable Toolkit, which is essentially an automated platform for founders that assists them to raise a round of capital. It all starts with learning in terms of capital raising, and it also gives you all tools and templates to empower you to raise a round of funding on your own, all available through a fully automated fundraising a platform, and that's called Fund Enable. So that is what precisely I do. Uh, uh, that is it from my side. So I have experience of around 10 years in venture capital. Before this, I used to be a part of a fund called Springboard Ventures. I also run another company called Indian Academy of Venture Capital, which is possibly the only company in India which conducts curriculum-based venture capital training programs for entrepreneurs. We have more than 10 city presence when it comes to these capital raising. And I run an investment bank that raises upwards of $10 million for Indian businesses. So that's my background, and that's what I do. I thank you for actually giving me an opportunity to be a part of this. So thank you so much, Sudeep. Really thankful to you for giving me an opportunity to talk to these people, to these entrepreneurs. And thank you, all of you, for being attentive. I know how difficult it is to concentrate on an online channel. You've given me your valuable time. I hope that I have added value, and I hope that I've kind of given you some points to think about. Over to you, Sudeep. And if you have any questions now, the last 15 minutes have actually dedicated for question and answer session. Thank you so much. Really appreciate. Thank you.
Thank you, Vikram. Thank you so much for the wonderful session. Yes, this is the right time to ask your questions and queries. Kindly unmute yourself, or you may put it in the chat, and Vikrant will answer it.
So there is one question on the chat, which I can see that, sir, in exit strategy, do investors check on how much time it takes for the return? Yes, very, very good question. Typically, a venture capital investor gives a 5 to 7 year horizon. That is all that they can, typically that is the time period for which they can wait. They cannot wait beyond that time. because a venture capital fund is like a mutual fund. They have taken money from some other investors, and to them they have to return the money in typically 10-year period. So the time that you get to give those returns is actually around 5 to 7 years. So Prantik, thank you so much for asking this question. Very, very important question. There is one question that we are working on: digitization and automation of village panchayats. Can we get investors? Very, very interesting. Only if you are looking at Goa, possibly that's not a scalable business model. If you say that this model can be applied to possibly every panchayat today, not just in India, but the similar structure which might be operating in Africa, in some of the Southeast Asian markets, then your business is actually scalable, and definitely, you can reach out to investors. What if the product is hard tech product and requires reasonable amount to start with? Very, very important question. What if you have a product which requires lots and lots of capital to even start monetization? What to do? Unfortunately, you will have to actually bring in that capital. There are a lot of schemes right now by DST, by Niti Aayog, by state governments. Like I'm giving you an example. There is a scheme called Bayrak Grant, etc. Right, which are available for startups. But typically, I have not seen any scheme which is more than 50 to 1 crore, 50 lakh to 1 crore. Typically, all these grants that you get, supports, are technically capped at somewhere around 50 lakh to 1 crore. If you need more money, then you will have to put in that money yourself, or you will have to find an investor who comes from your own network. So someone who really knows you, because a very, very pure play venture capital investor will not come to you invest at this stage when your product has still not received customer validation. So that's where it is important. Another question is it necessary to have a tangible product? Not necessary. So like an app or a website, a brand which is very famous right now called Licious. Okay, what is it? It's basically a portal, right? Not necessary that you need to have a hardware product. Whatever it is, you need to have customer validation. That is something which I can tell you for sure. So these are the questions that I could see on the chat window that I've answered. Any further questions, guys? Happy to answer. If there is a need for pre-seed or seed, are there specific investors for that? Today, at a pre-seed level, the best set of investors today that you might have are incubation centers. There are a lot of certain individuals that you can look for. For seed, obviously there are a lot of funds today. There are a lot of these seed funds and angel investors that come in at a seed funding stage. But given the today's situation, they are also asking for customer validation. That is the whole definition today that has changed for seed. There are a lot of micro VCs in India today, like Artha VC, 100x VC that you would have heard about. They come in at an early stage, but their check sizes again depend. So 100x VC comes with a check size of 25 lakhs to a crore. Incubators come in with a check size of 25 lakh rupees to a crore. There is a scheme called Nidhi SSS, which is there with a few of DST funded incubators. That is something which looks at that 50 to 1 crore of ticket size. So these are the various avenues that you can look at this point in time. Any further questions? Are there any platforms where a startup has its own listing and gets investors? Okay, so today, what has happened is there are certain rules and regulations related to such platform. So there used to be such platforms in the past. What happened was SEBI, which governs the equity investments or which governs stock markets, etc., said that there is a platform where there are startups on one side and investors on the other side. This is nothing but a stock exchange, right? You need to be regulated. So typically for a platform for startups where there are investors on one side and startups on the other side where you can list, it is slightly right now not clear, because we then start acting like what you can say exchanges. However, there are networks, there are angel networks, like there is India Angel Network, Mumbai Angels, Lead Angels, AHA Ventures, Let's Venture. These are the platforms which are there. These are networks of, or there is Venture Catalyst. These are basically entities where a lot of angel investors are there together, and they decide to invest together. So you can essentially go and reach out to these guys and look for investments. So the portals where you can check investor, one portal, I'm going to just type it out for you guys. So I've just given you a list of databases and reading material that you should read on a daily basis. Platforms like Inc 42. There's a very good platform these days called the KEN, KEN, which covers stories about startups and funding, etc. Obviously, your story is there. VCC Edge, VC Circle is there. So, information today when it comes to startup ecosystem is not a challenge and is not a problem at this point in time. You can get access to these. Um, Great. Any further questions, guys? I think these are the only set of questions that we have for today. Over to you, Sudeep. I think that's the questions that I've answered. Thank you so much. Over to you, Sudeep.
Thank you, Vikrant, for the wonderful session once again. And so, as discussed earlier, so we'll also be having one more session similar to VC funding, but covering other topics which are very important in VC funding. And if you don't have any other questions, then we can find it out.
Great. Thank you so much. Sudeep, again, once again, thank you.
Thank you.
Thank you all. Really thanks for joining. And I hope we stay in touch. And, all the best to all of you. Logging off.
Thank you.
You.
Thank you so much.
Thank you so much. Thank you.
And also all our participants in the session today.
Yeah, sorry, someone has a question? Okay, great. Thank you.